Testing, testing. All right, guys, good morning. My apologies for yesterday's aftermarket recap. Again, just 2 days of just bad luck in a sense. Good morning, everybody. Welcome aboard. It is 9 a.m. Eastern Standard Time, Wednesday, July 13th, 2022. Okay, so we did get the CPI number real quick regarding yesterday. My apologies. I was working from the office, and for some reason, my AirPods didn't link to the sound on OBS recorder. So I talked for about 8 minutes with a bunch of charts and no sound. That's if you've been watching us before, it's a pain in the ass sometimes with the OBS software to get the actual sound because the AirPods, which I use all day, and I ordered another pair just in case. I'm gonna have as a backup for the computer, so at least I won't have that issue anymore. I'll just leave one at the office. Okay, so let's get to it. Dow is down 336 points. Nasdaq down about 1.85%. S&P down 1.34. Russell down 1.21%. Crude oil is up slightly, 95.97. I did buy oil in terms of energy company yesterday. Bought some stock in it. That's what I was talking about yesterday. Gasoline futures are down 1.91%, $3.20. Gold futures down about 0.88%, 1709. Silver futures down 0.70 today. So even the commodities are taking a hit, except for crude oil. We do have inventories today at 10:30. The dollar did hit new 20-year highs, and it is now, or it was, I don't know if that is still the case. It's the euro dollar. Oh, it bounced a little bit. Euro dollar did hit below parity, below one for one. That's the first time that's ever happened. We came close before, but never below $1, or $1, €1. So the dollar is now at 108.45. 10-year yields have spiked 3.052% is where we are currently. The VIX is only up 4.21%. Obviously, this is just futures, 28.44 this morning. Let's go ahead and move forward. Euro dollar, again, like we talked about, 1.0011. Now, here's a trade that you may be like scratching your head. If we're at 20-year highs on the dollar and you have time on your side, this is probably where you want to go euro dollar long. I don't know if you want to go ahead and carry that kind of trade long term, but again, more than likely euro will bounce as economies improve, unless you think the eurozone is a complete disaster and it'll never recover. That's the deal. Bitcoin futures down about 1%, 19,140. We did fall and tapped to 19,000 off the CPI number. Dollar yen 137.63. That's up this morning, and Ethereum down about 0.34%, relatively holding up above that $1,000 level. Okay, so that's a lot to talk about. Let's go over the CPI number first. Okay, so CPI number, let me go ahead and get Twitter rocking. Okay, here we go. Here's the CPI number. Month over month, June, actual 1.3% over 1.0%. So that's higher than expected. The expectation was 1.1 number. And then we have CPI year over year, June, 9.1% versus 8.6%. Previous estimated 8.8%. So that's higher than any estimate. Core CPI, this is excluding food and energy, 0.7% versus 0.6%. Previous 0.5%, and U.S. core CPI year over year 5.9% versus 6%. The estimate was 5.7%. So I guess at least in terms of year over year CPI in the core sense has something, I guess, to look forward to. But again, I talked about this before, guys. You're gonna have a high print anyways. This was kind of expected, but this is basically the high end of it. So again, we know that break-even is rolling over. We know that yields are rolling over. Obviously, they spiked today. We know that gasoline, we know that crude oil fell. We know that commodities fell, gold, silver, those guys. Copper has been falling as well. So if we want to go and take a look at the copper on futures, even that's red as well. So again, still the weakening of commodities is based on the recession fear that the Fed will tighten us into a recession, which doesn't always happen. We've had pivots before where we had some kind of tightening and then we pulled back before a recession even hit. That was in 2019 with the same Fed chair, same Fed chair, same Fed governors. Well, some of them are changed, but the same kind of Fed cartel, let's call it, the same deal. So again, it's not like they haven't stopped before a recession, because they have. So what you're looking at here in terms of this number is that it's really bad. There's nothing to really kind of hang your hat on. I guess if you want to say it's, the core year over year. But again, this was kind of expected, just not as protruded or this high, in my opinion. I didn't think it was going to be this hot. But again, have some solace that at least next month's, because now we have all the commodity rollover, unless commodities tend to boost or are going to boost toward the end of the month, which again, we see the dollar still soaring. These commodities are priced in dollars. We may still see that continuation of weakness on commodities, and then we will get a lower CPI in August. That's really kind of the money month, let's just say. We'll probably get 75 basis points in July. August, there's no Fed meeting, but then we also have September. That I think that's looking at a 75 as well. That's kind of the signal that we're getting from the market in terms of Fed fund futures rate. So we have some information now with a CPI number. Tomorrow we have a PPI number, so that's something else. We already know that consumer sentiment, business sentiment is really low across the board. Just pretty much a malaise, let's just call it. So if we go and bring up the 3 week, and again, if we go ahead and just add let's add the RSI here. If you want to go ahead and actually give at least some color to the number. So again, the level that I'm looking for really is 3,500. I think the next shoe to drop would be the earnings report. That's why I haven't really went and started buying. The only thing I bought lately was some energy. But again, it hit 95 on crude oil. I was waiting for 92, 94. I added some Chevron to my portfolio. Again, pays a nice 4.1% yield. So again, at least we get some cash. And again, Chevron, at least in terms of their chart, is better off. We'll look at that here in a second. Take a look at S&P futures. Again, that 34.91, 35.18 level, that 200-day moving average next to that Fibonacci level. That to me is still that target. We're at S&P futures, so it is open. Again, we're like around 38 RSI. We know that 30 is an oversold level. Doesn't mean we can't stay oversold. But again, that should line up with that 3,500 level on oversold. So again, the target still remains. Again, we're just waiting for it to get there. The only thing, again, the fear I have is that we don't get there. And then we start rising because we still haven't had that really violent snapback bear rally. We've had little blips up and down, but nothing really crazy. Now, granted, we are down about 2% this morning, but again, 37.40 right now looks to be a good demand area. Again, we've kind of tapped it, but again, it's a triple bottom. Does triple bottoms usually hold? Usually not. So again, we'll see if we get continuation to the downside. We haven't even tested 37.40 or 37.45. The low print was around 37.52. With that being said, again, we got the number. The bandage is ripped in terms of the number. Now we're looking towards the future. What's next? So with that being said, here's some of the numbers that we got. Inflation. Groceries are up 12%. This is the year increase since 1979. Chicken is up 19% past year, biggest increase ever. Biggest since 1981 is gasoline. Electricity up 14%, highest since 2006. And rent is up 5.8%, largest since 1986. So again, a lot of the 80s analogy we talked about 1979, 1980, and 1981, 1982 being an analogy. And Investment Club knows about the 1982 analogy, and also here where August we actually boosted higher. The problem is here in terms of the S&P, if you are looking to short, you do have some levels that you can look for. And we have one more. It's this gap fill around 36.75. We should open right around 37.50 this morning with fair value on futures. If we get one more leg down, which is completely, understandable, especially with the CPI number, that'll get us to this gap fill around 36.75 on the 1 hour. The 1 hour will get us still oversold. We may just bounce there. The good news is that that's the last gap to the fill to the downside. We have way more gaps to the upside. For example, one here around 4,000, and we got, I think, one other one around here. No, just the one there. Maybe I'm missing it on SPX. But I got one more here around 4,011. So again, most gaps do fill. So again, the expectation is the lows are at least 36.75 that we will tap. It's either going to happen relatively soon, or we're going to have it post earnings. The problem is that we're getting such the malaise to the point where we have just too much. The negativity is almost priced in across the board, all surveys. So again, how low can you get before you get that bear market rally? I mean, how far can you go? And again, unless we're predicting a recession, again, we don't have that information yet. We need to see corporate balance sheets and corporate earnings to see if they are showing at least a complete slowdown or a stoppage in terms of earnings growth. I did read that 3% was the earnings expectation, which is actually pretty low. I'm a little afraid that's a little too low of a barometer, and that may be easy for the big boys to break. So, well, the one thing that I fear is that we don't get to 3690, 3,500 or so. That's the one thing I'm afraid of. With that being said, so it is a day by day market. I mean, I wouldn't be surprised if we did bounce. I wouldn't be surprised if we close down further. Both have their explanations in terms of why that the case would be for a bounce, because then you have 3740 as your demand side, and I can understand where we have the continuation flush to fill the gap down. We did fall this morning right around, let's call it 50 handles. We had a big pop initially to 38.73, and now we're bouncing here. Let's see what we get at the open. Here's the key factors that we want to see this morning. The dollar, as always, the dollar is key. So if the dollar can at least roll over down to 108, we're going to bounce on futures. If we start rejecting at least this gap fill on TNX, this is the 10-year yield, 30.91, then we can see if we can roll over as well. And possibly this has been priced in already. Again, we don't know until the cash open. Again, the two main things we're looking at is the dollar and yields today. That's the focus. In terms of crude oil, if you guys remember, I've been talking about it for a little bit, was really that 93 level. We did tap it, but we're really close, 93.47. Again, we're getting to support on crude. So again, that's where I started adding. I bought some Chevron yesterday with well, at least I did. Investment Club, I mean, they do what they like. But in terms of what I bought some Chevron with the good yield. Let's take a look at that Chevron chart. And you could see here, break of that 200-day. But again, you have that 136.16 level hanging out right there. So again, I think it's a good buy here. Could we get a little lower? Sure. If we do, there is I know there's no gap fill there. It's just a level of support around 119.31 on the daily. If we get there, you're talking about $70 gas anyways, or $70 barrel oil. If that's the case, maybe 80, maybe 70. If we do get there, that means inflation has completely rolled over, and then I definitely want to buy some more Chevron anyways. Also, Delta did report earnings this morning. They did beat on revenue on higher costs, which was passed down to consumers who flew, but yet their profit margins were squeezed because of that same energy cost, inflationary pressure. We did have DAL calls yesterday. We caught them yesterday. We closed them, and good thing we did because we reversed today. So let's go and answer some questions. Good morning. Thoughts on Delta earnings this morning? Again, the Delta earnings, I mean, again, we know inflationary pressures. The good news is that crude oil and gasoline are rolling over. Bad news is that gasoline doesn't matter in terms of Delta Airlines. It's crude oil because it's refined into jet fuel. So the main thing with Delta is that we need energy to come down. The good news is that it has. Keep in mind that the energy or Delta Airlines, they're reporting for last quarter. So again, we don't know. I don't know exactly when their quarter ends in terms of their fiscal quarter. If July is included in that, that's bad. If July is not included in that, which I expect, I think that's the case. It doesn't include this crude oil fall. Remember, just last month, we were at, for the 13th, we were at 122. We're at 96. You're talking about what, almost a 27%, 28% decline. So again, that's going to help some bottom line. So you can also say that with this commodities rollover and also this energy rollover and some inflationary data rollover, that it may not reflect on this quarter's earnings. What we're looking for this earnings is a slowdown in the consumer. We will get a retail sales number as well on Friday. If the retail sale number is too strong, that's not good because then the Fed is going to want to increase rates. But then that shows that the actual consumer or corporate earnings means it should be relatively strong. So we're kind of in a conundrum as well. We want bad news is good news and good news is bad news, unfortunately. So we had some bad news today in terms of inflation. What's the good news? What's the silver lining? Well, it's not including the commodities rollover we just had. So now are we going to price that in? Are we pricing in the future? That's really the question. And that's really just day to day on the market. That's why we're going to look at yields and that's why we're going to look at the dollar. Banks report later this week. Do you think we keep going down? Higher rates do help the banks, but the banks, the big thing for them is going to be their trading volume, their trading revenue. So their fixed income trading revenue, I expect it to be higher. The only thing I think that will offset that in terms of the banks will be mortgage volume, mortgage origination, because higher rates are hurting. So again, the banks do make money on volatile markets because of their trading desk. So they'll outperform there. Maybe fixed income trading, which is a big part of the revenue. But mortgage origination is going to be weak because of higher interest rates. So now your question is, in terms of the banks, how well positioned are they for a recession? That's probably something that's going to be talked about on their conference calls, possibly Jamie Dimon and the others. So the main thing in terms of the banks now we're looking at, we just had their stress test, right? We just had that stress test and they all passed. Some gave more capital buyback than others, and some kind of held pat. Citi and JPM holding pat. So the JPM call will be an interesting one. Let's hear what they have to say in terms of the consumer, in terms of credit card spend, and in terms of their focus in the future of the housing market. And they have a lot of data points from the consumer that can give us at least a little bit of a hint of what's to come. Has the consumer still trucking along even with higher incomes? Remember, those credit card balances or credit card usage from last week was lower than expected and revised lower 2 months in a row. So again, the banks, we need to see exactly where the consumer's at. Plus, we have that retail sales number. Do I want to trade the banks ahead of this tape? No, I don't. Do I want to own banks? Yes. If we get weakness, again, 3,500, I want to add banks to my portfolio too. What are some good stocks or sectors you're looking to get into this recession? What should we be looking at? Again, a good one here would be energy. Energy, again, provides capital return and a yield, and we know they have cash on their balance sheet. So again, we had that mean reversion back to close to pre-war, pre-invasion levels from Russia, Ukraine. So that probably gives us an opportunity to buy this weakness on energy as we considerably go higher if we do get a recession. Again, the supply chain hasn't changed. The real issue here is that commodity costs are going down because of recessionary fears. Now the question is, how low can we get on oil? How strong, how severe is the recession? Again, if you're looking for a recession kind of blockage or in a way to play it, you can do bonds just for the simple fact that at least it gives some kind of income directly from the government. And the second thing in terms of recessionary kind of defense will be consumer defensive. The problem is that they're expensive. So again, if you're looking at a Costco, Walmart, Dollar Tree, Target, Procter & Gamble, Altria, PepsiCo had a great number. Coca-Cola, they're just a little pricey here. You're buying it at a point where it's just too expensive now. We're buying fire insurance when the house is already on fire, is what I mean. If you're preparing for it ahead of time, you just want to stick to dividend paying companies with good balance sheets over time. But just prepare to take that hit. Recessions usually last about less than a year, 9 months. If you can ride that ship, great. If you can't, then don't buy anything. Defaults on loans are rising fast over the last few months with the banks. 42% of a full point next meeting. Yep. I just started reading that, the Fed funds futures. So with that being said, Austin, is that the defaults in the loans, okay, we do see that. We don't know if that's just one bank. Is that a consensus? I have to see the report from the banks and see where they are in terms of kind of the real tell in the bank's earnings is really when they start adding their loan loss reserve. Because when they start adding to that, that's usually fear because they're not using that money to pump out more loans. They're using that as a buffer of any kind of loss. So we had that in 2008, 2012, any kind of slowdown, recessionary slowdown, 2020, reserves were a lot higher. That's usually a leading indicator of what a recession may look like. So again, the banks meeting up is going to be extremely important. The question is here is that how low can we go? I mean, 3,500 is my level. How low of a sentiment can we go as well? Remember, the advanced decliners number are completely low. That very very low. We had put call ratios soar recently, just as much as yesterday. But now the question remains is that if the data points still line up as inflationary, let's say next month's is still inflationary, still high, even when the commodities roll over, which is pretty tough to see, then you start looking at recessionary risk to the point of 100% recession because now the inflation cannot be absorbed in such a long period. It just wouldn't work. So again, you would get that kind of 2002 next leg down. The question is, where's the bottom? And again, that's where we need the more data points as we go along. So I can't say, buy the dip here because we're not there. We're not dippy enough yet. So a lot of it is just trading and waiting. So we will see if 3740 does break. That's a key level here. And upside, again, in terms of the market, if we can recapture 3840, that was a key pivot point for the last 48 hours. Again, it did hit there and then rejected and came down. Now we're at post CPI. Really the thing I'm not looking at is not S&P futures. I'm looking at 10-year yields and I'm looking at the dollar. If the dollar soars higher and yields go higher, again, that'll sink markets. But again, if you start getting bond yields tanking too fast, that means that's going to take money away from the stock market. Remember, we're still at a low liquidity area because of the Fed actually tightening. So again, interest rates would fall at least short term, possibly down to 2.7. But again, there's a lot of moving parts here as we go along. We still need the corporate earnings. To me, that's the last key to this puzzle. So we'll be getting that pretty soon. All right, guys, have a great rest of your afternoon. We'll catch you guys later at 5 p.m. and recap it all. Cheers.